Welcome back to Squawk Alley. The market volatility continues. For more, let's bring in Keith Parker, head of U.S. equity strategy at UBS, who has the highest S&P target on the street, and Charles Babrinskoy, head of investment group at Ariel Investments. Keith, I'll start with you. Given what we've seen in the markets in the past week and a half, are you sticking by that S&P target?
We see what's transpired over the last week is quite extraordinary. We have the rise in rates, which helped drive a surge in the VIX. Some passive selling, which has driven quite a bit of volatility over the last week, and price to earnings multiples, which have shifted down by 2 times as rates have moved up pretty modestly. And so at these levels, we do see a buying opportunity as the fundamentals remain solid, data remains strong, and you're getting equities now at a 2 times discount to what they were just a week and a half ago.
And Charles, looking at interest rates and sort of the pretty dramatic move we've seen in recent weeks higher, and the fact that this definitely seemed on the heels of a Friday jobs report last week, on the heels of that this really sort of seemed to trigger all of this volatility. How much higher do you expect interest rates to go, and what do you think that means for equities?
Yeah, that's a great question. Everybody's agreeing that higher rates are bad for the market and are part of what's driven the market down, but people haven't done a very good job of quantifying that. So we went back to our models over the last couple of days. We have a model for the S&P and the value of the S&P. What we've found is if you take the discount rate up from, say, 8% to 8.5%, 50 basis point increase in interest rates, that produces a reduction in the value of the S&P of about 9%. So very similar to what we've actually seen in the market. We think the value of the tax cuts was about 11% to the good. And we think the benefit of all the regulatory environment, the tax cuts, was about a 1/4 point